So I want you to imagine a master architect, right? Like a guy who has spent his entire 30-year career building these very austere classical stone
Okay,
monuments.
I'm picturing it.
He is just utterly obsessed with durability, predictability, tradition. He builds structures that are designed to look exactly the same a century from now.
Right, build to last forever.
Exactly. But then one day, you look at his newest blueprint, and he's suddenly building this like 100-story neon skyscraper made entirely of experimental gravity-defying glass.
I mean, honestly, I would immediately assume someone hacked his computer.
Right.
Or perhaps that he sees some fundamental shift in the laws of physics that the rest of the structural engineering world has just completely missed.
And that is the exact puzzle we're decoding today in the financial world. We're looking at what happens when one of the most famous, disciplined, traditional value investors, someone legendary for holding the most boring, durable consumer staples, just suddenly dumps his entire U.S. portfolio.
Just completely clears it out.
Yeah, and dumps it right into the most aggressive, cutting-edge artificial intelligence and tech hardware stocks on the planet.
It's wild. It really forces a complete reevaluation of how conservative institutional capital is navigating this whole technological transition.
It does.
Because it challenges the very definition of what a safe asset actually is.
So today, we are doing a deep dive into a really fascinating document. We've got the Q1 2026 Form 13F filing for the Oriental Harbor Investment Master Fund.
Managed by the renowned Chinese fund manager Dan Bin.
Exactly. And we're going to explore his $1.133 billion U.S. equity portfolio, look at how he has completely redefined Warren Buffett's classic investment playbook for the AI age, and, what his extreme bets mean for the future of technology.
There's a lot to unpack there.
There really is. But before we look at the actual holdings, I want to make sure you, the listener, have the tools to follow this kind of extreme institutional movement yourself. So, to access more advanced researches, follow Gurus' latest movement, and leverage our latest Deep Values agents, welcome to download the Deep Values app from the App Store.
It's highly recommended if you want to track this stuff.
Yeah, and if you want to verify the macro environment driving these trades, like to track stock market temperature, welcome to download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
Perfect. And just setting the parameters for today's deep dive, I need to add that all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service.
Right.
So please conduct your own due diligence before making investment or financial decisions.
Absolutely. Okay, so let's lay the groundwork here. Because to really grasp the magnitude of what Oriental Harbor is buying right now, you have to understand who is doing the buying.
Right, the context is everything.
Yeah. Dan Bin isn't some Silicon Valley venture capitalist who's just chasing the next shiny object. Historically, he is this fiercely disciplined proponent of Chinese domestic equities.
Specifically, durable consumer staples.
Yes. He is most famous for holding massive, massive positions in Kwaichow Mutai, which is a premium Baijiu distiller.
Which is really a textbook franchise investment. Yeah. I mean, Beiji relies on deeply ingrained, predictable consumer behavior, right? Yeah. It has incredibly high margins, brand loyalty that spans literally generations. People buy the liquor, they drink it, they go buy more.
Exactly. It's the Coca-Cola playbook. Right. And that Graham and Dodd Buffett-style philosophy yielded a 26.3% annualized return since his offshore fund launched in March 2016.
Which is incredible.
Right. And across their publicly tracked strategies, they recently saw a 3-year return of over 140%. So he built this fortress by betting on human habits that just never change.
Which is exactly what makes this new 13F filing look almost like a clerical error.
Literally.
Because that $1.133 billion U.S. portfolio has been almost 100% repositioned into the artificial intelligence value chain.
And the concentration is just staggering to me. We are talking about 97.56% of the assets sitting in just the top 10 holdings.
Right. He's dropped the classical stone monuments and just gone all in on the neon skyscraper. But the interesting part is he claims he is using the exact same architectural principles.
Wait, really? How does he justify that?
Well, he genuinely believes he's applying the exact same theory.
Yeah.
He hasn't abandoned the philosophy of value investing. He's basically evolved it for an era of technological hegemony.
Okay, explain that a bit more.
So traditional value investing looks for low historical valuation multiples, high tangible book value, and predictable consumer demands, right?
Yeah, the boring stuff.
Exactly. Dan Bin has taken that framework and adapted it. He's looking at modern computing platforms and hardware bottlenecks as the new unbeatable monopolies.
Ah, so he's looking for the modern toll bridges.
Precisely.
Hmm.
But the macro view here is really critical. He doesn't see generative AI as just like a software feature update or a passing theme.
Right.
The sources note he views it as a foundational industrial transition that will last 10 to 15 years. He compares it directly to the mobile internet expansion, which drove markets for 13 years.
Oh, wow. Or like the PC hardware build out before that.
Exactly. And recognizing that time frame is really how he justifies his departure from traditional conservatism. He operates on this concept called omission risk.
Omission risk. Okay, so what does that mean in practice?
Dan Bin argues that missing out on the dominant economic beneficiaries of a paradigm shift is far more dangerous than the risk of buying them at a cyclical peak.
Wait, so he's arguing that avoiding high growth equities simply because they look expensive on a, traditional spreadsheet that practically guarantees your portfolio's purchasing power will erode over the next decade.
That's his thesis, yeah. If you sat out the internet boom because Amazon's price-to-earnings ratio was just too high in 2012, you lost against inflation.
Right.
So traditionalists fear the bubble, but Dan Bin fears the omission.
Okay, but how does he manage the downside? The mechanism he relies on for safety in these expensive trades is what he calls valuation multiple digestion, right?
He isolates companies with absolute pricing power and exceptionally high returns on invested capital.
So the thesis is that these companies will grow their free cash flows so aggressively over the next few years that their future earnings capacity will just compress those sky-high multiples down to very safe traditional levels.
Exactly. The growth digests the multiple.
Okay, I have to push back on that, though, because that assumes there won't be a single macroeconomic hiccup or a recession or, a regulatory crackdown in the next 5 years to derail those earnings.
It is definitely an aggressive stance.
It's essentially pricing in perfection.
Yeah.
I mean, buying tomorrow's cash flows at today's astronomical prices sounds a lot less like value investing and more like just hoping the music never stops.
No, you're right. It does carry massive execution risk. But Dan Bin views these specific AI platforms as insurmountable monopolies.
Like actual toll bridges.
Right. If a company controls the absolute only bridge into the future of digital commerce and enterprise productivity, they can essentially dictate their own revenues. If the moat is deep enough, the current price tag is just an optical illusion created by backward-looking accounting.
Okay, let's see how that theory translates into actual capital allocation. Because there was a massive, undeniable strategic rotation this quarter. Oriental Harbor completely liquidated their Microsoft position. They sold all 193,527 shares for roughly $94 million. That's a 100% exit from one of the most dominant enterprise software companies on Earth.
And that capital didn't just go to cash either. It was redeployed into Alphabet, Google's parent company.
Yeah.
They purchased $79.67 million in the Class A voting shares, which adds to their already massive $345.63 million holding in the Class C shares.
And they also hold a leveraged ETF on Alphabet, right?
Right, they do.
So when you aggregate all of that, Alphabet now accounts for an astonishing 39.80% of his entire portfolio.
It's massive.
That is $450.95 million. Alphabet is officially the central pillar of his entire thesis, surpassing NVIDIA. Think about the conviction required for that.
It's almost unimaginable for a traditional fund.
Yeah, I mean, if you are sitting at home listening to this and looking at your own retirement account, imagine allocating almost 40% of your entire net worth to a single search engine company.
Well, calling it a search engine company severely understates the structural advantage Dan Bin sees here.
Yeah.
You have to look at Alphabet through that toll bridge lens.
Okay.
The core Google search engine processes over 90% of global internet queries, right? So that creates this impenetrable data network effect. But the real mechanism protecting that toll bridge is their vertical integration in the AI space.
Let me test a theory on why this moat is wider than Microsoft's. Because Microsoft has to buy chips from NVIDIA to run OpenAI's models, and then they have to sell that software to enterprises.
Right.
But Alphabet doesn't have to do that. They design their own custom silicon, right? The tensor processing units.
Yes, the TPUs.
And they train their own proprietary Gemini models on their own world-scale data. And then they push those models directly into a distribution network of billions of users through Android and YouTube.
Exactly.
Because they own the hardware, the software, and the distribution, they don't have to pay a middleman at any step of the process, so they capture the entire economic rent of the AI transaction.
That is the exact mechanism. They are immune to the hardware margin compression that threatens other software companies. Plus, under their current management, they've implemented serious cost discipline and massive share repurchases.
So to Dan Bin, Alphabet isn't a speculative tech play.
Not at all. It is a classic, high-quality compounding franchise, generating massive free cash flow, and it's trading at a multiple he believes is artificially depressed by antitrust headlines.
Okay, so he sells Microsoft's enterprise software to double down on Alphabet's vertically integrated toll bridge. But the 13F reveals he didn't just stay in software. He moved aggressively down the technology stack, away from consumer applications and into the cold, hard, physical bottlenecks of the AI revolution.
He went straight for the physical infrastructure layer, basically the picks and shovels of the gold rush.
Yeah, so let's talk about NVIDIA. It sits as his second largest holding at 19.79% of the portfolio. Now, the casual narrative is just that NVIDIA makes the fastest chips, right? But the sources highlight that the real economic moat protecting this position isn't the silicon itself.
Right, it's the software ecosystem.
Exactly.
NVIDIA spent nearly 2 decades establishing CUDA as the foundational programming language for parallel computing and AI development. The mechanism here is massive developer switching costs.
Oh, because they'd have to rewrite everything.
Exactly. If an enterprise wants to move away from NVIDIA hardware and buy a cheaper chip from a competitor, they have to rewrite millions of lines of code and retrain all their engineers.
That friction is almost impossibly expensive.
It is. Add in NVLink, their hardware interconnect system, and NVIDIA is selling entire data center scale supercomputers, not just loose components.
But Dan Bin clearly realized that even NVIDIA relies on someone else to physically print their designs. Because in this quarter, he initiated a brand new $70.87 million position in TSMC, the Taiwan Semiconductor Manufacturing Company.
Which is 6.26% of the portfolio.
Yeah, and this is a direct bet on the ultimate physical manufacturing bottleneck.
Because TSMC manufactures over 90% of the world's leading-edge silicon chips. Apple, NVIDIA, AMD, none of them actually make chips. They just draw the blueprints. They all physically rely on TSMC's fabrication plants.
So the structural pricing power there must be infinite, because TSMC requires, what, $30 to $40 billion annually in capital expenditures just to maintain their technological edge? Nobody can afford to compete with them.
It's an insurmountable barrier to entry.
Yeah, if TSMC decides to raise the price of manufacturing a wafer by 15%, NVIDIA and Apple just have to pay it because there is literally nowhere else on Earth to get those chips printed at that scale and precision.
And they just pass those inflationary costs directly onto the largest tech monopolies in the world.
Unbelievable.
And to complete this hardware trifecta, the fund initiated a new $24.67 million position in Micron Technology.
Okay, they manufacture memory chips, right?
Specifically, high bandwidth memory, or HBM3E and HBM4, which are physically required to feed data into NVIDIA's processors. It prevents bandwidth bottlenecks during AI training.
Okay, this is where we had a massive contradiction in traditional value theory, because Warren Buffett historically despises memory chip businesses.
Oh, absolutely hates them.
Because memory is a commodity. It goes through brutal, predictable boom and bust cycles with massive supply gluts and terrifying price crashes. So why would a disciplined value investor touch Micron?
Because Dan Bin is calculating that the structural undersupply in AI hardware temporarily overwrites that traditional cyclicality.
Temporarily.
Right. The physical limits on how fast TSMC can package these chips and how fast Micron can yield high bandwidth memory creates this multi-year window where supply simply cannot meet the hyperscaler demand.
Ah, I see.
He sees a period of absolute pricing power that will generate enough cash to justify the position before the cycle eventually turns.
So if the AI revolution really is a gold rush, he's not buying the prospectors, and he's not even buying the shovel makers. He is buying the only factory on Earth that possesses the intellectual property to forge the steel for the shovels.
That is a perfect way to visualize the hardware bottleneck thesis.
I mean, I can follow the logic for Alphabet's vertical integration, and I understand the structural pricing power of TSMC. But if we dig deeper into this 13F filing, we find allocations that completely break the traditional rules of capital preservation.
Right.
If he's perfectly willing to redefine a semiconductor foundry as a value stock, where else is he bending the rules of traditional finance to capture yield?
Well, we have to talk about the leveraged ETF derivatives.
Exactly. The portfolio holds 7.22% in TQQQ, which is a 3 times daily leveraged NASDAQ ETF, and it holds 2.26% in GGLL, a 2 times leveraged Alphabet ETF.
Right.
We are talking about nearly 10% of a billion-dollar value fund sitting in highly volatile daily leveraged derivatives. Help me unpack the mechanics of this, because holding these long-term usually destroys capital through beta slippage, right?
Yes. From a strict value perspective, holding these derivatives is financial heresy. Because these ETFs rebalance their leverage daily, They suffer from mathematical decay in anything other than a perfectly straight line up.
Let me break down how punishing that math actually is for anyone listening who hasn't traded these. Let's say you buy a normal $100 stock and it drops 10% today. It's worth $90, right?
Yeah.
If it recovers and goes up 10% tomorrow, 10% of 90 is only 9. So your stock is now worth $99. You've lost $1 just to the market chop.
Exactly.
When you apply 3 times leverage to that daily oscillation, that daily chop completely cannibalizes your capital. In a flat, sideways market, a leveraged ETF will bleed out and eventually go to zero.
Because the mathematical decay actually scales with the square of the leverage factor.
Wow.
So a 3x leverage product incurs a volatility drag 9 times larger than the underlying index. Dan Bin understands this continuous time math perfectly. He is systematically accepting that known, quantifiable decay to essentially strap a multiplier onto his highest conviction ideas.
He knows this car leaks oil, but he's only driving it in a straight line for a quarter-mile drag race.
That's a great analogy.
He believes we are in a unidirectional bull market for tech, and he's using the ETFs as a tactical speculative overlay to capture extreme beta.
It is entirely tactical. And this willingness to explore non-traditional financial architecture, it actually extends to his 0.27% stake in Circle, which is the issuer of the USDC stablecoin.
Yeah, I saw that. It's only a $3.03 million position, but the mechanics behind it are fascinating.
They really are.
I mean, a tiny crypto position for a value investor.
Yeah.
What is the fundamental mechanism driving that?
Well, Circle operates what is essentially an insurance float model. So when institutions buy their stablecoin, they hand Circle fiat US dollars. Circle takes those billions of dollars in cash, invests them in short-duration US Treasury bills, and keeps all the yield.
Sneaky.
Right. They earn the risk-free rate on a massive reserve while paying zero interest to the people actually holding the digital tokens.
It's the classic financial float business model, literally the exact same model Warren Buffett used to build Berkshire Hathaway with Geico insurance premiums, but applied to digital assets. They are monetizing the plumbing of the crypto ecosystem.
Yes, it provides asymmetric upside to the institutional adoption of blockchain without taking any direct exposure to volatile token prices.
Okay, let's zoom out and look at the systemic vulnerabilities here, because if you are listening to this and looking at your own portfolio, you might be wondering if your safe index funds are actually exposing you to this exact same concentrated risk. You can't concentrate $1 billion this aggressively without creating massive architectural flaws.
That's the trade-off.
So what happens if this highly leveraged, highly concentrated bet goes wrong?
Well, concentration builds tremendous wealth, but it completely isolates risk. This portfolio is incredibly vulnerable to the CapEx cycle.
Okay, the CapEx cycle.
Yeah. Alphabet, NVIDIA, Meta, TSMC, and Micron make up over 74% of this fund. The entire operation is tied to AI enterprise capital expenditure.
Wait, so the CapEx cycle risk means that if Microsoft, Google, or Amazon suddenly realize they aren't making enough subscription revenue from AI software to justify buying more hardware, they just stop buying.
Exactly.
And if they stop buying, this entire house of cards collapses from the top down.
The hyperscalers are currently spending tens of billions on infrastructure. If they pause that spending, the compute stack crashes simultaneously.
Yeah.
The hardware makers lose their orders, the foundries lose their volume, memory prices crater, and the multiples just collapse back to reality.
Because the entire supply chain is feeding the exact same beast.
Exactly.
And beyond the cyclical risk, there is a terrifying geographic reality to this portfolio.
Right, the geopolitical single point of failure. By holding nearly 20% in NVIDIA and over 6% in TSMC, the fund is entirely dependent on the physical continuity of the Western Pacific semiconductor corridor.
Any military friction or blockade in the Taiwan Strait immediately halts the global hardware supply. That creates systemic, portfolio-wide drawdowns that you simply cannot hedge against.
No, you can't.
So Dan Bin's portfolio is a masterclass in high-conviction allocation, but it's balancing on a razor-thin geographical and cyclical wire.
It really requires an iron stomach and just a fundamental belief that the major powers will maintain the status quo out of mutual economic necessity.
To bring us all together, we've explored how Dan Bin, a legendary consumer value investor, pivoted from predictable Chinese liquor into becoming a technology hardware maximalist.
It's a historic pivot.
We've seen how he uses the concept of omission risk to justify paying high multiples for tomorrow's cash flows. We've watched him consolidate almost 40% of his wealth into Alphabet's vertically integrated toll bridge and aggressively buy up the physical bottlenecks of the AI revolution with TSMC and Micron.
And all while utilizing mathematically decaying leveraged ETFs to juice his returns.
Exactly. And reviewing these institutional 13F filings isn't about blindly copying their trades. The objective is to dismantle the mental models of brilliant capital allocators and determine what risk actually means to you in your own financial framework.
Right. It's about understanding the why behind the what.
Which leaves us with a final thought to chew on. If every traditional value investor eventually redefines massive, high-multiple technology companies as safe, structural toll bridges, does the definition of value investing lose its meaning entirely?
That's a fascinating question.
Are we just creating a new hidden bubble where everyone convinces themselves that absolute tech monopolies are the new, boring consumer staples?
I guess the market will deliver the answer to that question over the next decade.
Maybe that classical architect building the neon skyscraper hasn't lost his mind. Maybe he just realized that in a world where the ground is shifting beneath our feet, stone monuments are the most dangerous things you can build.
Very true.
Thank you for joining us on this deep dive. Keep exploring, keep questioning, and we'll catch you next time.